This video covers the Chapter 2 Learning Objective 1, Compute a Predetermined Overhead Rate. Predetermined overhead rates are a critical piece of job order costing systems and really of cost accounting systems in general. So we hit on those a lot throughout the next few chapters here. Now, in thinking about predetermined overhead rates and how they're used, one thing we have to define is the allocation base by which overhead costs will be applied in the job order costing system. So allocation bases like direct labor hours, labor dollars, machine hours, and so on are going to be used as a measure of the assumed kind of resources that each job consumes during the production process. They're the mechanism by which we're going to assign overhead costs to individual jobs. We use an allocation base or this activity base or measure because it's impossible or at least difficult or not cost effective to trace overhead costs to particular jobs. Remember, by definition, overhead costs are all indirect costs, and indirect costs are not easily associated with individual products or services being provided. So we have to have some kind of measure by which to get these things assigned to individual jobs, some measure of the sort of relative resources that each job consumes. Now, second here, overhead does consist of a whole bunch of different items, some that are really small, like the grease used in production equipment, to some that are much more significant, like a production manager's salary. So we want to have an allocation base that hopefully reflects, again, the relative resources that each job is kind of consuming or assumed to be consuming. And then lastly here, a lot of these overhead costs, things like utilities, and property taxes and maintenance costs and supervisor salaries and things like that are fixed, or at least have big fixed components, even though our output, our production might fluctuate during any particular period or across periods. So we want to have some kind of measure of the relative resources that these things are chewing up or consuming or assumed to be consuming throughout the period. Now, the predetermined overhead rate is going to be determined before the period begins. That's the predetermined part of that term. Right? So the POHR is going to be calculated always in the same fundamental manner, and that's by taking the estimated total manufacturing overhead cost for the upcoming period divided by the estimated total units in that allocation base for the same period. Now, ideally, that allocation base, as we spoke of a minute ago, is some kind of cost driver that we think best indicates or causes the incurrence of these overhead costs, these indirect production costs. So real quick here, think about this one for a second. The fact that one department may be labor intensive while another department is machine intensive explains in part why multiple predetermined overhead rates are often used in larger companies. Pause that and think about it for a quick second, and then I'll be right back with the answer here. So that is true. We want to use allocation bases that are most indicative of the driving or incurrence or causing of these indirect costs. So if one department is very labor intensive, it should use an allocation base of some measure of labor, whether that's labor hours or labor cost or whatever. On the other hand, for a department that's very automated, very machine intensive, it should use a more appropriate driver for that environment, like machine hours or machine time, or however we're defining that. Now, the reason that we use predetermined overhead rates in job order costing systems is that the actual overhead for the period isn't known until the period ends. So we wouldn't be able to estimate job costs during the period if we didn't figure out a way to assign these costs or allocate these costs as we work on all these jobs. Second, actual overhead costs can certainly fluctuate seasonally. If you think about things like utilities, which are more in the winter and summer, or certainly even things like property taxes, which only hit a couple times a year on average. So really we could be producing some information that's misleading for decision makers if we're not assigning these costs on an ongoing basis based on the full year estimates. Right? We kind of want to smooth these costs, in other words, throughout the upcoming period. Now, the predetermined overhead rate is calculated using a sort of four-step process here. First, we want to estimate the total amount of that allocation base the activity base, the cost driver, whatever term you prefer there, that would be required for next period's estimated level of production. So if we're using a measure of labor, like direct labor hours, we want to come up with an estimate of the total labor hours we expect to use up to produce whatever we're going to produce in that upcoming period. Maybe it's 20,000 labor hours. Second, we want to estimate the total fixed overhead cost for that coming period and the variable overhead cost per unit of the allocation base. So we'll go through all the fixed overhead costs like property taxes and supervisory salaries and things like that, and get a big total of those, things that won't change with any change in production. And then we want to estimate that variable overhead cost per unit of that allocation base. So for anything that's fluctuating with activity, maybe utilities has a variable piece, right? Maybe some maintenance charges have variable pieces, something like that. We want to decide, again, what's that variable cost per unit of the allocation base? So in my earlier example, per labor hour, or per machine hour if we're using machine hours, or whatever. Then we want to use our handy cost formula that we learned about in Chapter 1 to figure out what that total estimated overhead for the whole year is. So we'll take that fixed piece, represented by A here, and add to it the variable piece per unit we estimated, times our expected activity level in terms of that allocation base. This is just coming up with total estimated overhead for the period. And then we'll use that to calculate the predetermined overhead rate. So predetermined overhead rate is again our total estimated overhead for the period divided by that total estimated activity or allocation base for that same period. In my very brief example where we're using labor hours, that means we want to come up with a rate that expresses some amount, some dollar amount, $10 per labor hour, so that as I work on jobs that I can apply that overhead cost, those overhead costs, to jobs using that single predetermined overhead rate. So let's look at a quick example here. Let's say Pearco estimates that it will require 160,000 direct labor hours to meet the coming period's estimated production level. In addition, they've estimated the total fixed overhead for the year is going to be $200,000, and that the variable overhead cost for that same period should be about $2.75 per direct labor hour. So to come up with our predetermined overhead rate, the first thing we want to do is figure out what that total estimated overhead for the year would be. And we'll use our cost formula to do that. Fixed overhead of $200,000 plus the variable piece, $2.75 per labor hour, times the 160,000 expected direct labor hours. And that gives us total estimated overhead of $640,000. So then our predetermined overhead rate becomes the $640,000 estimated total overhead cost divided by the 160,000 estimated direct labor hours we're going to have in that same upcoming period. So when we do the math out there, we get $4 per direct labor hour. And as we'll see, as we start to work on jobs, we're going to apply overhead costs at this rate of $4 per direct labor hour to every single job as we work on it. So as jobs have labor put toward them, we'll assign $4 per labor hour worth of overhead costs to that same job. All right, let's look at another example here. Almoraz has two manufacturing departments, forming and finishing. The company used the following data at the beginning of the year to calculate predetermined overhead rates here. So we see the estimated total machine hours in both departments, estimated total fixed overhead in each, and then the estimated variable overhead per machine hour in each department. Now assume that the company uses a plant-wide predetermined manufacturing overhead rate based on machine hours. So plant-wide rate, not an individual rate for each department. That predetermined manufacturing overhead rate per machine hour is closest to which of these answers? So just pause this for a second, work that out, and then check your answer here in a second. That answer is A, $6.62 per machine hour. So the first thing we have to do is come up with the total estimated overhead for the upcoming period. In the forming department, that's $40,600 in fixed overhead, plus 7,000 estimated machine hours, times the $1.30 in estimated variable overhead. In the finishing department, that's $8,100 in estimated fixed overhead, plus 3,000 estimated machine hours times the $2.80 in estimated variable overhead cost over there. So there's our 49,700 and 16,500 respectively in those two departments. Now we're using a plant-wide rate, so we'll add those together to get a total estimated overhead plant-wide of 66,200. Divide that by the total estimated machine hours across both departments, so 10,000, and that gives me my predetermined overhead rate of $6.62, again, per machine hour. Back up and review any of this if you need to, and then move on to the next video, which would cover applying overhead costs to jobs and coming up with total job costs.